All right, let's talk about one of the biggest moves you can make in Los Angeles, buying a condo. Now, I know it can feel like a maze full of hidden traps, but our goal today is to give you the map and the flashlight to get through it like a pro.
So you're probably thinking, a condo? Yeah, it's basically a house, just smaller and easier, right? Less yard work, cheaper, simple. Look, that's what almost everyone thinks at first, and it's a mistake that can lead to some really nasty surprises later on.
Okay, let's break this down. When you buy a house, it's all yours. The walls, the roof, the patch of grass out front, your kingdom, your rules. But with a condo, it's different. You own the space inside your unit, sure, but you share ownership of everything else: the lobby, the pool, the gym, even the roof over your head. And that shared stuff is run by a homeowners association, the HOA. And that, my friends, changes the entire game.
To get you through this, we're going to go on a little 5-part quest. First up, we'll lay out the LA Condo Challenge. Then we'll figure out how to master the all-powerful HOA. After that, we'll do some detective work that goes beyond your 4 walls. We will solve the tricky condo financing puzzle. And finally, we'll arm you with the ultimate buyer's checklist.
So what's the real challenge here? It's shifting your mindset. You're not just buying a piece of property. You're buying into a community. And you're also becoming a shareholder in a small business that's in charge of a multi-million-dollar building. And the value of your investment is completely tied to how well that business is run.
And that leads us directly to our first, and I mean this, most important quest: mastering the HOA. The Homeowners Association is the government of your building. Getting a handle on its rules and, more importantly, its financial health is absolutely mission critical. Think of this as your official HOA interrogation. You need to ask the tough questions. What exactly do my monthly fees pay for? Are you planning to raise them anytime soon? Are there any special assessments lurking around the corner? And what about the rules that actually affect your life? Can you bring your dog? Can you rent the place out if you need to? Can you finally get rid of that awful shag carpet? The answers are buried in the HOA docs, and you have to be the one to dig them up.
Now let's talk about the HOA's piggy bank. It's called the Reserve Fund. This is the shared savings account for all the huge, expensive stuff that will eventually break or wear out. We're talking about the roof, the elevators, the plumbing, the fun stuff. A fat and happy reserve fund is probably the best sign of a well-run building.
So how fat is fat enough? Here is the magic number you need to remember: 70%. The HOA's reserve fund should be at least 70% funded based on what their official study says they'll need. If you see a number lower than that, it is a massive red flag. It means if the roof starts leaking tomorrow, they won't have the cash to fix it. And guess where they're going to get it?
Ding, ding, ding. That's where special assessments come into play. In California, the HOA board has the power to slap every owner with an extra bill for up to 5% of the yearly budget. And they don't even need to ask for a vote. Anything bigger needs a majority vote. But this is how they cover those rainy day shortfalls, and it could mean you get an unexpected bill for thousands of dollars.
Okay, so you've grilled the HOA on their finances. Now it's time to put on your detective hat and investigate the actual building. This is where all that financial paperwork meets the physical reality of where you're going to live.
This quote really says it all. You just can't trust a fresh coat of paint. You have to be proactive and dig for the issues that are going to impact your life and your wallet for years to come.
So here's the kind of stuff you're looking for. Are the walls paper thin? Can you hear your neighbor's TV? Try to visit at different times of the day to really check the noise levels. How's the light? Go in and turn off every single light to see what the natural light is actually like. And you've got to ask the big, boring questions. How old is that roof? When's the last time they updated the plumbing? These are the invisible problems that become very, very expensive headaches.
And speaking of headaches, there's a really critical California law you need to know: Senate Bill 326. This law forces condo buildings to get regular safety inspections on anything that's elevated and outside. Balconies, decks, walkways. It was put in place to prevent those structures from failing.
And here is the really crucial part for you, the deadline. That first inspection has to be done by January 1st, 2025. Then they have to do it again every 9 years. You have to ask to see the building's SB 326 report. Make sure it's done and make sure any repairs they found have been fixed.
All right, you've vetted the HOA's money. You've inspected the building. Now you face the final boss battle: getting your loan approved. See, financing a condo is a whole different beast because the bank isn't just lending to you, they're lending to the entire building.
They're betting on its health too.
And this brings us to a term that can kill a deal dead in its tracks: non-warrantable. A condo building gets this label if it doesn't meet the strict guidelines set by the big mortgage players like Fannie Mae and Freddie Mac. If a building is non-warrantable, your loan options just shrink, and the loans you can get will be more expensive.
So what freaks a lender out? What gets you that non-warrantable tag? Well, a few big things. If there's a major lawsuit against the HOA, that's a huge red flag. If the financial reserves are weak, remember that 70% rule? That's another one. And a big one is if there are too many renters compared to actual owners living in the building.
Yeah, let's zero in on that last one, because it trips a lot of people up. Lenders feel much safer when the majority of residents are owners. Ideally, they want to see more than 50% owner occupancy. Once that number dips below 35%, a lot of lenders will just walk away. The thinking is pretty simple. Owners have more skin in the game, and are more likely to take care of the building. So here's the bottom line financially. Even for a perfect, warrantable condo, you should probably expect slightly tougher loan terms. Your interest rate on a condo loan might be a little bit higher than for a single-family house. And very often, lenders will want a bigger down payment, think 20 or even 25%, just to buffer their risk.
Okay, we have been through the gauntlet, the finances, the inspections, the legal stuff, and now it's time for the prize, your final checklist. This is the secret weapon, the elixir of confidence that boils everything we've talked about down to a simple, powerful action plan.
Here it is, your 6 steps to condo buying glory. 1. Read every single page of those HOA documents. Yes, all of them. 2. Get that reserve study and budget and hunt for that 70% funding number. 3. Get your eyes on the SB 326 balcony report. 4. Confirm the building's master insurance policy is solid. 5. Go through the seller's disclosures with a fine-tooth comb. And 6. Check that owner occupancy ratio. Seriously, if you do these 6 things, you'll know more than 90% of the other buyers out there.
Look, buying a condo in LA is a serious quest. It takes preparation and it takes knowledge. It's so much more than just finding a cool view or a nice kitchen. It's about making a smart, secure investment in your future and in a community. So I guess there's only one question left. Now that you have the map, are you ready for the quest?